Hey everyone, and if you are new here, welcome. Before we start, thank you. This channel is growing because of you. Every view, every comment, every subscribe, I do not take that for granted. Now, let's get into it. 20 million barrels of oil pass through a single waterway every day. That is 1/5 of everything the world consumes, flowing through a corridor narrower than most city highways. The Strait of Hormuz sits between Iran and Oman at the mouth of the Persian Gulf. It is 104 miles long, and at its narrowest point, the navigable shipping channel spans just 2 miles in each direction. Through this corridor moves approximately $600 billion worth of energy trade every single year. No other maritime passage on Earth carries a comparable share of global energy supply. And right now, that corridor has effectively shut down. What that means for oil prices, natural gas markets, inflation, and the global economy is the subject of this analysis. Welcome back. To understand what is happening in the Strait of Hormuz today, you must first understand what flows through it and why there is no substitute. Because this is not simply an oil story. It is a story about the architecture of the global economy itself. And the numbers that define that architecture are staggering. In 2024, oil flow through the strait averaged 20 million barrels per day, according to the United States Energy Information Administration. That volume represented 27% of all maritime oil trade and approximately 20% of total global petroleum liquids consumption. But crude oil is only part of the equation. Approximately 1/5 of the world's liquefied natural gas trade also transits the Strait of Hormuz, primarily from Qatar. 1/5 of global LNG through a single passage. 30% of Europe's supply of jet fuel originates from or transits through this waterway. Strait transit volumes include approximately 1.5 million barrels per day of liquefied petroleum gas and 1.2 million barrels per day of naphtha, according to Bloomberg NF. OPEC members Saudi Arabia, Iran, the United Arab Emirates, Kuwait, and Iraq export most of their crude through the strait. Qatar, one of the world's largest liquefied natural gas exporters, sends virtually all of its LNG output through this channel. The destination of this energy is overwhelmingly Asia. 84% of the crude oil and 83% of the LNG that moved through the strait in 2024 went to Asian markets. China, India, Japan, and South Korea accounted for 69% of all crude flows. The concentration of dependency is extraordinary. This means that the economic health of the 4 largest Asian economies is directly tethered to the uninterrupted functioning of a 2-mile-wide shipping lane on the opposite side of the world. That is the structural reality. Saudi Arabia moves more crude through this strait than any other country. In 2024, exports of crude and condensate from Saudi Arabia accounted for 38% of total Hormuz crude flows, or 5.5 million barrels per day. The strait is deep enough and wide enough to handle the world's largest crude oil tankers. It has functioned as the primary artery of global energy trade for over half a century. And in that entire history, it has never been fully closed. That record just ended. Until now. On March 2nd, 2026, a senior commander in Iran's Revolutionary Guard Corps officially confirmed that the strait was closed. Any vessel attempting to transit the waterway would be targeted. The threat was not ambiguous. Ship tracking data confirmed the reality on the ground. Tanker traffic dropped by approximately 70% initially and then fell to near zero. Over 150 vessels anchored outside the strait. At least 5 tankers were damaged and 2 crew members were killed. Major container shipping companies, including Maersk and Hapag-Lloyd, suspended all transits through the strait and related routes. Protection and indemnity insurance was withdrawn for March 5th, making the economic risk too high for any commercial operator. The strait was not formally blockaded under international law, but it was effectively closed. The distinction is academic. When insurance is withdrawn and ships are being targeted, no commercial vessel will transit regardless of legal status. The immediate market response was historic. Brent crude surged by 10 to 13% in initial trading, rising above $82 per barrel. Oil prices have climbed more than 12% in the days since the disruption began. And that may be just the beginning. European natural gas prices surged more than 60% in a single week after Qatar ceased liquefied natural gas production following attacks on its facilities. The British gas futures contract rose approximately 21% in a single session. The Dutch contract jumped 25%. Energy markets across the continent entered what traders described as panic mode. The cost of hiring a supertanker to ship oil from the Middle East to China nearly doubled from the previous week's rate to a record high of more than $400,000. Insurance premiums, which had already reached a 6-year high before the events, became effectively unpriceable. OPEC Plus pledged to increase output by 206,000 barrels per day to mitigate shortages. Analysts noted that this volume represents approximately 1% of the displaced flow. The gesture was symbolic, not structural. The gap between what was promised and what was lost is measured in orders of magnitude. To understand the severity of what is unfolding, it helps to measure it against every comparable energy disruption in the modern era. The historical record provides both context and warning. In 1973, Arab producers, led by Saudi Arabia, imposed an oil embargo on Western nations. That embargo removed approximately 4.4 million barrels per day from global supply, roughly 7% of world consumption at the time. Oil prices rose 300%, from $3 to $12 per barrel. The economic consequences reshaped Western energy policy for a generation. In 1979, the disruption following a major revolution in the Persian Gulf region removed approximately 4% of global supply. Prices more than doubled. The economic consequences lasted years, not months. Inflation became embedded in the structure of Western economies. In 1990, the Gulf disruption caused a brief doubling of oil prices from $17 to $36 before coalition action and strategic reserve releases restored confidence. The disruption was severe but short-lived. In 2022, the freezing of certain sovereign reserves and related energy disruptions removed approximately 1 to 2 million barrels per day from supply, contributing to prices spiking above $130 per barrel. Now consider the current scenario. A full disruption of the Strait of Hormuz removes approximately 20 million barrels per day from global markets. That is 4 to 5 times the magnitude of the 1973 embargo in absolute terms. It is the largest potential supply disruption in the history of oil markets. The 1973 embargo removed 7% of global supply and caused a 300% price increase. A Hormuz disruption affects 20% of supply in a globally interconnected just-in-time economy. Economists describe the expected result as a non-linear price response. Standard models likely underestimate the impact. Analysts from multiple institutions have outlined a range of price scenarios. Under a partial disruption, where some flows continue, the effective supply loss ranges from 5 to 10 million barrels per day. Under a full closure, the loss reaches 17 to 20 million barrels per day. The difference between those two numbers is the difference between a recession and a depression. Some analysts project oil prices could reach $100 per barrel if disruptions persist beyond 1 week. Under more severe modeling, prices of $120 to $150 per barrel are projected within days of a confirmed full closure. One analysis modeled a sustained full closure scenario in which prices approach $180 to $200 per barrel. That would represent levels not seen in inflation-adjusted terms since 1979. The question every analyst is trying to answer is whether bypass infrastructure can compensate for the lost flows. The answer, according to every published assessment, is no, not even close. The numbers make the impossibility clear. Saudi Arabia operates the East-West pipeline, also known as Petroline. It spans approximately 1,200 kilometers and can transport up to 5 million barrels per day to ports on the Red Sea. However, terminal infrastructure at the Red Sea and limits actual throughput. The pipeline capacity and the export capacity are not the same number. The United Arab Emirates has the Habshan-Fujairah pipeline, approximately 400 miles long, connecting inland oil fields to the port of Fujairah on the Gulf of Oman. Its capacity is at least 1.5 million barrels per day. Combined, the unused capacity from these two pipeline systems is approximately 2.6 million barrels per day, according to the U.S. Energy Information Administration. That represents less than 15% of the displaced flow. Diverting oil to bypass routes would still leave a shortfall of 8 to 10 million barrels per day. The arithmetic is unforgiving, and there is a critical constraint that most analysis overlooks. More than 90% of OPEC's spare production capacity is located in Middle East countries that export through the strait. If the strait is closed, that spare capacity cannot reach global markets regardless of whether it is activated. The oil exists, but it is trapped. The International Energy Agency estimated spare crude oil production capacity at approximately 5.4 million barrels per day as of mid-2025. But if that oil cannot physically leave the Persian Gulf, its existence on a spreadsheet is irrelevant to global supply. Strategic petroleum reserves provide the other potential buffer. IEA government-controlled stocks totaled more than 1.2 billion barrels at the end of the first quarter of 2025. The United States Strategic Petroleum Reserve held approximately 400 million barrels of crude. That sounds substantial until you measure it against 20 million barrels per day of displaced flow. Combined with obligated industry stocks of approximately 900 million barrels, the total emergency buffer is substantial. But drawdown at maximum rates can only sustain a partial offset for a limited period. The reserves were designed for disruptions measured in weeks. They were not designed for the removal of 20% of global supply. The cascading effects extend far beyond oil. The liquefied natural gas dimension is equally consequential. Qatar, the world's second largest LNG exporter, ships virtually all of its output through the strait. That volume is approximately 9.3 billion cubic feet per day. When Qatari LNG facilities were targeted and production was halted, the impact rippled through European and Asian energy markets immediately. South Asia faces the most acute exposure. Qatar and the United Arab Emirates account for 99% of Pakistan's LNG imports. They supply 72% of Bangladesh's and 53% of India's. More than half of India's LNG imports are linked to Gulf supply. A sustained disruption simultaneously lifts oil import costs and LNG contract prices because a significant share is Brent indexed. Analysts describe this as a dual physical and financial shock. The pain compounds from both directions at once. China is the world's largest crude oil importer and purchases more than 80% of Iranian oil. Around 30% of its LNG imports come from Qatar and the UAE, and roughly 40% of its oil imports pass through the strait. Japan and South Korea, with minimal domestic energy production, are among the most structurally exposed economies on Earth to a Hormuz disruption. South Korea's net oil imports represent 2.7% of gross domestic product, making it among the most vulnerable on the current account front. The inflation transmission mechanism operates through both direct and indirect channels. The direct channel is fuel, heating, and transportation costs. The indirect channel is input costs for manufacturing, agriculture, and logistics. Everything that moves, grows, or gets built becomes more expensive. The International Monetary Fund estimates that a 10% increase in oil prices adds approximately 0.3 to 0.4 percentage points to global headline inflation within 12 months. A 50 to 100% increase in oil prices, which is within the range of current projections, would add 2 to 4 percentage points to global inflation in a sustained scenario. Central banks face what analysts describe as the classic supply shock dilemma amplified to extraordinary proportions. Tightening monetary policy into an energy-driven economic contraction risks deepening the downturn. Holding rates steady risks, allowing inflation expectations to become permanently embedded. There is no good option. The Federal Reserve faced this exact dilemma in 1973 and chose delayed response. That choice allowed inflation expectations to become entrenched. The correction ultimately required aggressive rate increases that produced the deepest post-war recession. The institutional memory of that failure shapes every policy discussion today. One analysis modeled that a closure lasting more than 30 days would push global recession probability above 75%. GDP contractions of 1.5 to 3% are modeled for major importing economies under a 3-month closure scenario. During the 1980s tanker conflict between Iran and Iraq, both sides targeted oil tankers and shipping infrastructure throughout the Persian Gulf. Iraq was responsible for 283 attacks. Iran accounted for 168. The campaign of mutual destruction lasted from 1981 to 1988. Despite that sustained campaign, the strait was never fully closed. Even at the most intense point of the tanker conflict, no more than 2% of ships passing through the Gulf were disrupted. Iran kept the strait open because it depended on the same sea lanes for its own vital oil exports. Self-interest was the guardrail. That historical pattern held for 40 years. Every threat to close the strait was ultimately a bluff, because closing it damaged the closer as much as the target. Iran exported $67 billion worth of oil in the financial year ending March 2025. Its economy cannot survive without that revenue. But the current situation has broken the historical pattern. The calculus has shifted. When the perceived threat is existential, the economic self-interest calculation that kept the strait open for decades no longer applies. That is the variable that changed. The companies rerouting their ships around the Cape of Good Hope in southern Africa face weeks of additional transit time and dramatically higher costs. The alternative route adds approximately 3,500 nautical miles to the journey from the Persian Gulf to Europe and 2,000 miles to Asia. For the broader energy landscape, this moment may represent a structural inflection point. A prolonged disruption would accelerate 3 trends that were already underway before the current events. The first is the acceleration of alternative energy infrastructure investment. Every major importing nation is now confronting the strategic vulnerability of depending on a single maritime corridor for a fifth of global energy supply. The policy response will be measured in trillions, not billions. The urgency has been permanently elevated. The second is the permanent diversification of supply chains away from Gulf dependency. Nations that were already pursuing energy independence will accelerate those timelines. Nations that were not will begin. The structural incentive has shifted from gradual transition to urgent necessity. The third is the repricing of energy security risk across every asset class. Insurance markets, shipping markets, commodity markets, and sovereign debt markets are all simultaneously adjusting to a world in which the Strait of Hormuz can no longer be assumed to remain open. The Congressional Research Service noted that the strait has never been completely closed in its entire history. Every prior threat was deterred by a combination of economic interdependence, military presence, and strategic self-interest. The deterrence framework has now been tested in ways it was never designed to withstand. The precedent is now set. Analysts have presented 3 scenarios for the coming weeks and months. Each carries fundamentally different implications for the global economy. Scenario 1 is the rapid de-escalation outcome. Diplomatic channels produce a ceasefire, insurance is restored, and ships resume transit within 1 to 2 weeks. In this scenario, oil prices retreat from their current levels, but remain elevated above pre-disruption prices. The crisis premium fades partially but does not disappear. The precedent has been set, and the strait can be closed. That knowledge permanently changes the risk calculus. Scenario 2 is the sustained partial closure. The strait remains contested for weeks to months, with some traffic resuming under military escort, but volumes well below normal. Oil prices settle in the $100 to $120 range. The global economy absorbs a permanent increase in energy costs. In this scenario, importing nations draw down strategic reserves, activate bypass pipelines, and compete for alternative supply from non-Gulf producers. Inflation accelerates in every major economy. Central banks are forced into impossible policy choices. The tools they have are not designed for this kind of disruption. Scenario 3 is the prolonged full closure. Transit remains at zero or near zero for an extended period. Oil prices enter what analysts call price discovery territory. Potential targets range from $150 to $200 per barrel. In this scenario, the economic consequences are measured in percentage points of global GDP. Recession probability exceeds 75%. The disruption forces a fundamental restructuring of global energy trade that takes years to complete. The world that emerges on the other side is structurally different from the world that existed before. Some analysts have described this potential outcome as 3 times the severity of the 1973 embargo and the 1979 disruption combined. That comparison is not rhetorical. It is based on the relative volumes of supply removed from global markets. The math does not exaggerate. There is one additional dimension that distinguishes the current moment from every prior disruption. In 1973, Western nations were the primary consumers of Middle Eastern oil. Today, Asia is the primary consumer. China, India, Japan, and South Korea collectively depend on Gulf energy at a scale that did not exist 50 years ago. A sustained Hormuz disruption does not simply raise energy costs, it restructures global economic competition. Energy exporting nations that can bypass the strait gain competitive advantage. Energy importing nations that cannot source alternatives face industrial contraction. The published data from the Energy Information Administration, the International Energy Agency, the Congressional Research Service, and every major investment bank tells a consistent story. The Strait of Hormuz is the single most critical choke point in global energy infrastructure. There is no adequate substitute, and for the first time in its history, it is effectively closed. The Russia-related energy disruption of 2022 removed approximately 1 to 2 million barrels per day from global supply. That disruption alone contributed to Brent crude spiking above $130 per barrel. It added measurably to global inflation for over a year. The Strait of Hormuz disruption threatens to remove 10 to 20 times that volume. Consider the scale of economic interdependence that runs through this corridor. The Persian Gulf holds approximately 55% of the world's known oil reserves. Even the remote possibility that long-term access to this much oil could be impaired permanently changes how every sovereign government calculates energy security. The calculus has shifted overnight. The cost of insuring a very large crude carrier for a single transit through the strait rose by $250,000 even before the current events. With insurance now withdrawn entirely, the commercial shipping industry has made its assessment. The risk is incalculable. No premium is sufficient when the probability of total loss cannot be modeled. Companies that rerouted shipping through the Cape of Good Hope during the Red Sea disruptions in 2024 absorbed additional costs measured in weeks and millions per voyage. The Hormuz disruption is structurally different. The Red Sea carries a fraction of the energy volume. Hormuz carries a fifth of global supply. Russia stands to benefit from this disruption more than any other major energy exporter. With Middle East barrels facing logistical disruption, both India and China face strong incentives to deepen reliance on Russian crude supply. India faces the most acute near-term exposure and is likely to pivot toward Russian supply immediately. The proximity and established logistics make it the path of least resistance. The IMF has estimated that oil price increases feed through to consumer inflation within 6 to 12 months. But in the current environment, where energy costs are rising simultaneously with supply chain disruptions and elevated sovereign debt, the transmission may be faster and more severe than historical models predict. What the market is pricing right now is uncertainty. What it will price next depends entirely on whether that 2-mile-wide corridor reopens. Every day it remains closed, the structural consequences deepen. Every week compounds the damage. The trajectory of global energy markets, inflation, monetary policy, and economic growth for the remainder of 2026 now depends on a 2-mile-wide shipping lane between Iran and Oman. That is the arithmetic. And the arithmetic does not care about headlines. It only cares about barrels per day. The question is not whether this matters. The question is how long it lasts, who adapts first, and what the world looks like on the other side. The data is published. The clock is running. Stay informed.